Alright, so I'm going to shoot this video so that not just you can understand your payment, but so that I can share it with the public and help in helping other people kind of review their payments and understand what's going to what. So right here on the screen, you see Carl's Mortgage Calculator, Carl with a K. They have this in the app stores for Google and iOS. I'm not sure Android probably too, but Carl's Mortgage Calculator is a great tool because you have the loan data, which you can put in your owed amount, you can put in your interest rate and how many years the loan is for, which most mortgages are 30, and today's rate 5.625. And then for your expenses, what I did is I have the HOA at $257 per month. That's from the listing on the internet. And then the insurance is $1,500 a year, which would equate to the monthly payment in here, the total. And the taxes at 1.4% of $470,000, which is your purchase amount, will be expected to be $65.80. So right here, let's talk about the payment. First of all, the $480,000 and $105. This comes from the VA funding fee. Because you're buying the property with 0% down, we fall under first use, less than 5%. Next time you go to use the VA loan, I would advise that you would use a 5% or more down payment. That way, instead of paying 3.3%, you would be paying 1.5. So for the first use, less than 5%, which 0 down is less than 5%, we have 2.15. Right, that funding fee can be added to the loan amount, and normally is. It's very unlikely that somebody has the seller pay this or they pay it out of pocket themselves. So that is a simple calculator, just your normal run-of-the-mill calculator. Let's see what $470,000 borrowed times 1.0215. So this is going to give us 102.15%. Of the borrowed amount is $480,105. So you see that this funding fee, and what does the funding fee do? So first of all, we have to answer, what does the VA loan do? The VA loan allows for us veterans to purchase property with 0% down, as low as 0% down. You can also put a down payment, as you see on this funding fee chart, and your funding fee will go down. But in return, the VA is going to guarantee to the person that's putting their money for us to use for this purchase, the VA is going to guarantee to that person that 25% of that money is insured by the VA. So what does that mean? That means if we borrow $400,000, that $100,000 of that $400,000 is protected for that person. So if you were to buy a house 0 down and then stop making the payments and the house goes into foreclosure, and the bank takes it back, still the investor is sitting back like, oh gosh, where's my money? The bank will go through with the sale. If they sell it for a loss, then the VA will make that person whole up to a 25% loss. So in order to afford to do such insurance, the VA charges us veterans a VA funding fee. And here's the chart as to measure how much you should expect your funding fee to be. All right, so that's why our owed amount is $480,105 instead of $470,000 with 0 down. Now, the interest rate on your packet, for your disclosures, for your loan disclosures, it reveals an APR, which is annual percentage rate. This is an interest rate. There is a difference. So when I took to ChatGPT and said, hey, ChatGPT, if the quoted APR for a VA mortgage, including the 2.15% funding fee added to the loan amount, comes to 5.898%, what would the interest rate be on said mortgage? And over here, we see numbers that are less than 5.625, but you can see that 5.625 is the highest one. So I'm going to quote you with the highest one. That way, if your total payment comes in lower than the amount in this video, you'll be happy. If it comes in higher, you would not be happy, so I'm using the higher amounts. So in order to look up the estimated tax rate, I have here 1.4% on the address that you're buying. So if we go back to our calculator, the 1.4% of $470,000. So if we go 470 times 1.4% equals 6580. So we're using 6580 in the tax block. So now we have taxes, insurance, and HOA all included for about $3,700 per month for this 2-bedroom with an office / third small bedroom. So we have our whole deal here, and here's what I would expect your payment to be at the highest to be expected. So let me talk about what goes where. Here we already talked about the insurance and the taxes. This insurance and taxes is added to this. So let me take off this $257 on HOA and I'll show you what it is. So you're going to make a payment to the bank for $3,437 per month. And then in that payment, this $1,500 and $6,580 are going to be paid by the mortgage company because they're collecting the difference between $2,763, which is just your principal and interest, and $3,437. That difference is going to be stored in what's called an impound account. So from the impound account, when the bill comes due for taxes, the mortgage company makes that payment. The reason they do that is because if a homeowner were to fall behind on their taxes, then the government, the local government, could foreclose on the home. And they would be left holding the bag. They as in the bank and the investor. So in order to avoid anybody from not making their tax payments, the mortgage companies have taken on the responsibility of collecting the monthly amount and making the semi-annual payment, which is usually every 6 months here in this market. So the insurance works the same way, except that they make one payment per year and every year going forward. So if your insurance costs go up, then the mortgage company still makes the payment of the higher amount, but you'll owe them a little bit more. So now instead of $3,437, your bill would be $3,460 or $3,470 or $3,510, whatever is the appropriate amount for them to recover that excess money. Taxes, they go up slowly, but they go up, and the slowly is a 2% tax rate. Well, a 2% increase is our protection here that we have in California, and it's not 2% of the property amount, it's 2% of the tax bill. So if we go to our calculator and say 6580 times 1.02, if next year the house is worth more money, then the local government can assess your taxes and raise it to 6711. If we then subtract the 6580, that's $131.60 increase the next year. If you divide that by 12, oh, I times it by 12, so now we have to divide it by 12 twice. So divide that by 12 and then divide that by 12. This could increase your payment by about $11 per month next year. And then the next year, they could do the same thing, right? So it grows slowly, but the principal and interest, that's where it stays the same for the life of the loan. Here, if we go on a monthly tear, in January, your first payment, if you were to close in January, then your first payment would be due probably around, no, it would be due in March. March the 1st is your first payment. So let's see if we can find the date. I know there's a date somewhere around here so that we can start the payment in March instead of January. Let's go here, summary, annual, monthly payments. I'm not seeing the start date anywhere. Let's see, maybe it's in loan. Yep, there it is, start date. All right. Oh, all right, so it was hiding back there. So let's say 2026, okay? And then your payments start in March. So March the 1st, we'll call it the 2nd since that's the Monday. So March the 2nd is your first payment due. I'm going to come back to the monthly. And in March, when you make that payment of $3,437 to the bank, then we're going to see $2,763 going to the principal and interest. So the first month's interest is $2,250. You see how the next month it's a little bit less and a little bit less and a little bit less? And then principal being the amount that's coming off of your owed amount, the first payment principal would be 513. The next payment, 515, 518, 520, 522. You see how that's growing? So this one's growing and this one's shrinking. If you go all the way, if I slide this bar all the way towards the end of the loan, you would see how it's flipped. So at the end of the loan, you're paying your payment, and in said payment, there's still the $2,763 for principal and interest. $316 is going to interest, and $2,447 is going to off the owed amount. See, this is a really good indicator of why when we approach that 5 and that 10-year mark, why people are hounding us big time for refinances. Because if you see, when you first started the loan, they were getting $2,250 a month in interest, right? If we go 5 years, they're already down to only $2,100 a month in interest. And then if you go 5 more years, which is your 10-year mark, now it's at $1,800 a month in interest. And look at this, you're almost taking off $1,000 a month every single month in that 10-year period, right? If you go to 15, they're really upset. They're like, oh my gosh, look at this. They're almost at the halfway point of how much interest and how much principal is coming off, right? And then if you go 5 more years, they really want to wrap you up into a new loan, because here is $1,201 and 1,050 or 562 coming off, so 1,200 only on interest paid, right? So that's a quick lesson of like how the mortgages work and how we can expect for our money to go to where it's going to. So if we go back to the calculator, I just wanted to show you this. Your total expenses here are the 673. That's because if we go 34, 37 minus the 2763, we would get that 673 and 33 cents. You see? So we see that we're on track. Now we go back to our expenses and say the second check that you have to write every month is to the HOA, and the HOA rate right now is $257. This can also go up because the HOA, it's in charge of quite a bit. It's in charge of the roof, the exterior of the buildings, the parking lot, the gate, the pool, the landscaping for the community, including that dog park and the barbecue area. So they have all these responsibilities, and for $257 a month, it's a pretty good deal. Me at my house, I don't have a large lot. It's about a half an acre, but the grass there's not a whole lot of grass, but there is some grass. And I pay my guy $180 a month to come by every week and cut the grass and trim my trees and trim my hedges every couple of months. But they have the same kind of persons that are out there taking care of the grounds and taking care of the grass and taking care of the bushes. So they've got to collect that from each owner to take care of just the landscaping alone. That's not even including the pool and the roofs and the outer structures and the parking lot and the gate. Those gates malfunction, and you don't want them malfunctioning for long, because they would be keeping you in or out of access from your house. All right. So another cool tool on Carl's Mortgage Calculator that I like to share with people is that you can come in here for the prepayments, and the extra is my favorite. I already have it kind of pre-staged for after that first year. If I'm going to start making extra payments to the principal, I can come in here and plug it in. So if I were to say, let's say I can afford to make a $500 extra payment starting on month 13, and then I come over here and change that to month 36. So making that, or 360, sorry, that would be the end of it. Making that change takes our 30-year mortgage to, what's that, 21 years? In year 21, it would be paid off, right? So it's very powerful to make those extra payments. And before making those extra payments, it's nice to be able to have a tool like this to go in there and say, what if I made a $200 a month increase, right? What would that be? Well, that's going to go from 2026 to 2051, so that's knocking off 5 years off of the mortgage. Pretty good, because now you can say, okay, well, I'll have this thing paid off in 25 years from now. Right now, I'm 44, so that would put me at 69. So if I'm like, well, if I want to have everything paid off by the time I'm 58, if I want to have this one paid off by the time I'm 58, how much would I have to put? So 58 for me would be 1981 plus 58. So 2039, right? And so let's see how much I have to put to pay off by 2039. Would $650 do it? Nope. Would $850 do it? Nope. Would $1,200 do it? Yeah, almost there. Would $1,300 do it? Nope. How about $1,500? Oh, well, that's a lot. 11,500. Nope. 1,500. Okay, so basically 1,500. Let's call it in 25. Nope. How about 50? All right. So $1,550 per month, starting in month 13. Extra would get it paid off in 14 years, and I would be 58 years old. Right. So it's pretty cool to be able to play with. I do encourage you to get comfortable with this calculator and understanding your payment. And let's go through the summary again. So we're at a $480,105 owed amount because of the VA funding fee. It's 2.15% for your first use, less than 5% down, which is 0 is less than 5%. So our owed amount is $480,105. Our interest rate is 5.625. When we factor in everything, the APR for that loan is 5.898, which does not go into this calculator, but nice to know. And then your term is 30 years, and your payment is $2763.76 to your principal and interest. Between the HOA, the insurance, and the property taxes, we're at $930 per month, which makes our total payment projecting at $3,700 per month. All right. Thanks for your time today. I hope this helps, and I hope you can understand a mortgage payment more deeply so that you understand what it is that you're paying for and how that benefits you.